The stock market has been struggling mightily over the last month, which is a little odd to see at this time of year. I mean, April is usually one of the better months for the markets, but with things like a more hawkish Fed, continuing supply chain disruptions, inflation, and more, it is certainly understandable that we've been seeing more volatility than normal. With that being said, over the past 5 years that I've been making videos on this channel, I've generally tried to stick to more evergreen topics. Things that'll have some value to viewers, hopefully long after the video is originally uploaded, even if some of the numbers in the examples do change from time to time. However, I've also made a point of checking in on various aspects of market downturns whenever there seems to be elevated levels of fear of an oncoming recession. In 2018, we examined the history of stock market crashes in general, covering how deep the drops typically were and how long they took to recover, among other things. In 2020, we examined how sudden large drops in the market tend to play out, and came to the conclusion that most of them tend to blow over within about 6 months to a year, which coincidentally is more or less what happened with the markets in 2020. Today, we'll be doing something similar. Let's examine what typically happens after the markets experience a more pronounced and sustained sell-off, like we just saw in the month of April. Because while nobody can know for sure how this particular sell-off will end up, I've always found that having a general idea of what typically happens can go a long way toward helping me calm my nerves in the heat of the moment so that I don't shoot myself in the foot and can better plan out my short and long-term financial moves. Or the lack thereof, as is sometimes the case. So with that being said, the markets just experienced their worst April in over 50 years. Here's what typically happens next. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to my Patreon page. This is the best way to show your support for this channel, and in addition to that, you can also get early access to new videos and exclusive content such as spreadsheets based off the ideas we discuss in these videos. The spreadsheets will allow you to play with your own numbers and see how big of a difference some of the ideas we discuss can make for your own personal financial situation. Now, before we get into the actual data, I do want to make one thing clear. While I did say that the markets have just experienced their worst April in 50 years, this sort of experience is not unusual. The markets, as measured by the value of the S&P 500 anyway, lost a little over 9% in the month of April. The last time we experienced a loss greater than that amount in the month of April was in 1970. And this is only the 4th time since the late 1920s that the markets have experienced that kind of loss in this month, which all sounds pretty bad. But if we expand the scope a little bit, it begins to appear much more normal. Because at the end of the day, the markets are really only off their previous all-time highs by about 11 or 12% as I'm writing this in early May. So we're in correction territory, which is often defined as a drop of 10% or more from prior highs, but we're still a little ways off from crash territory, which is often defined as a drop of 20% or more from prior highs. And that is a totally normal place to be at some point during, well, almost any given year. In fact, per data from Yale professor and economist Robert Shiller, since 1928, the S&P 500 has seen a drop of at least 10% from the start of the year, about 62% of the time. Sometimes these drops are recovered from relatively quickly, to the point that we almost forget that they happened in the first place. Other times they turn into more prolonged downturns that we remember for quite a bit longer. But a drop of this magnitude is completely normal. With that being said, let's get into the actual data and take a look back at market history to see how things typically go following a rough start to a year like we've experienced in 2022. For the remainder of this video, I'm going to be breaking down the data into a few different categories based on how far we're looking ahead to determine what typically happens after a sell-off, as well as the severity of that sell-off. Basically, I'll be looking at the short, intermediate, and long-term prospects of a market that has experienced a major sell-off, which we'll define as a market that has crashed at least 20%, a minor sell-off, or a drop of at least 10% but less than 20%, and just all years regardless of the severity of the drop. This will enable us to see what typically happens following a market drop similar to the ones that we've seen so far this year, which would fall into that minor sell-off or correction category, as well as how it compares to more or less severe downturns. So even if you happen to be watching this video a few weeks, months, or years after its original upload, you'll still hopefully be able to get something out of it, regardless of what the market conditions are at that point in time. We'll start by looking at the short-term prospects of the market following a recent sell-off. The short-term prospects for the market, which for today I'll be defining as the performance performance of the markets over the remainder of the year where the sell-off occurred is actually surprisingly good in most cases. On average, since 1928, the markets have experienced price drops from prior highs of about 16% in any given year. The median price drop for the year is about 13%. As I said a moment ago, the markets experience correction level losses at some point in roughly 62% of all years since 1928. Crash level losses are experienced in roughly 25% of all years. But despite all this, by year's end, the markets are up more often than not. Looking at every year since 1928, the chances of the market ending the year higher on a price return basis is about 68%. In the years where the markets experienced a minor sell-off, which again for this video means a drop of at least 10% but less than 20% at any point during the year, the markets posted positive price returns about 70% of the time. It's when the markets experienced major sell-offs or price drops of at least 20% at some point during the year where things get a little more dicey. They still ended the year with positive gains roughly 20% of the time, but due to the severity of the drop and potentially a very short amount of time for a recovery to take place, especially if the drop just happened to occur later in the year, the short-term outlook was less than stellar. Looking at the average growth rates, we see a similar picture taking shape. For the time period as a whole, the average single-year price returns was around 8%. For years where the markets experienced a correction, the average price return was even higher, at around 9.8% per year. And in years where the markets crashed, the overall price return for the year tended to average around negative 9.7%. And while that is negative, it is something that I find to be somewhat comforting, since what we're essentially saying is that in those years where the markets fell by at least 20% at some point, they ended the year down only about 10%, suggesting to me at least that a recovery was already well underway. And we can test this assumption by expanding our time horizon and looking at the performance of the markets over the intermediate term. If the recovery is typically well underway by the end of those years where we experience the drop, we'll see that reflected in the percentage of periods that see net positive growth and in the average return figures for this category. And as it turns out, that is exactly what we see. The intermediate term prospects for the market is a bit harder to pin down precisely, since what qualifies as intermediate term varies from person to person, but for today I'll be considering intermediate term to be anything between 1 and 5 years. And when we start looking at the prospects for the markets over those time spans, we can see a trend developing. Here is a chart showing the chances that the markets experience price gains over the various time horizons for all years in this sample. As you can see, while it isn't necessarily a consistent jump up every single year, since occasionally you may experience a second down year in years 3, 4, or 5 of the time horizon, which will temporarily drop those markets back down possibly below where they started out in year 1, the general trend is that as the time horizon expands from 1 year up to 5 years, the odds of experiencing gains in the markets rises. A similar story holds true when looking at only the years that experienced correction and crash level drops at some point. In terms of growth rates, we actually see a somewhat different pattern playing out, where the average annualized price returns for all years tend to decline more often than not as the time horizon gets longer. However, this actually does make a lot of sense when you think about what's going on. We know that over time, the stock market has historically grown at a rate of about 7 to 10% per year over the past century. So when we experience a down year, or even a down period within a year, you'd expect that you'd eventually get some above average returns to get yourself back up to that long-term average growth rate. In other words, we'd expect there to be some sort of reversion to the mean eventually. Investors know this, and so they act upon it by buying the dip. And that's kind of what we're seeing here. In the short term, we're getting that reversion to the mean in the form of above average returns following a correction as investors buy the dip, and then over the following years, once the markets have had enough time to recover, we see growth rates settle back into their more normal ranges, which are actually slightly lower than the 7 to 10% in these particular charts, since we're only looking at price returns today, and those obviously don't include dividends being reinvested. The crashes, since they are by definition more severe than corrections, and usually take longer to bottom out and recover from as a result, don't see positive annualized average price returns until around the 5-year mark, but we do still see investors buying the dip and eventually turning things around. Over the long term, which we'll define as 10 years today, we see these trends continue to develop. The chances of making money in the markets continue to rise, with the odds being nearly 9 and 10 for the years that experienced a correction, but not a crash, in this sample. And growth rates have mostly settled into their long-term average ranges following corrections, and they continue to rise following crashes. So there you have it. It seems that in years where the markets experience a correction level drop, but manage to avoid an outright market crash, things tend to go pretty darn well, even in the short term. Over that short-term period, the markets tend to make money on a price return basis somewhere in the neighborhood of 70% of the time. Over the intermediate term, that success rate may get bumped up a bit, and after a decade, history suggests that there's a near 9 in 10 shot at making money on a price return basis. And realistically, these are somewhat conservative figures, since again, we're looking only at the price returns of the S&P 500. If we included dividends that you'd earn on an index fund, then not only would the overall returns be higher, probably by about 2 to 3 percentage points per year on average, depending on the time period you're looking at, as dividends used to account for a larger portion of overall gains than they have in recent years, but so would the chances of making money when all is said and done. I was just more interested in looking at how the markets themselves tend to respond to these types of situations, so my focus was more on the price return side of things today. But it is worth keeping this difference in mind, since in the real world, the trajectory of our net worth will be influenced by the periodic dividends we earn on our investments, in addition to those price returns of the market. Anyway, when the markets continue to fall into crash territory, things tend to look a little bit bleaker, at least over the short term. But on the bright side, it does seem that the recovery starts fairly quickly after the markets bottom out, with overall return figures consistently trending upward with each successive year that the time horizon expands. And even after just a few short years, the chances of earning money in the markets on a simple price return basis rises to about that of a coin flip, and they continue to rise as the years go on. It's also worth noting that much of the lackluster results from the crash figures come from just one crash: the Great Depression. If we looked at the data since the end of the Great Depression, here's how it would compare. As you can see, the average price returns actually turn positive by the time you reach a 2-year time horizon, and by 10 years, they actually aren't all that far off from what we're seeing from the long-term returns of all years in this sample. A similar phenomenon would play out if you just looked at more modern times, such as over the last 40 years. The point is, the Great Depression is such an outlier in the history of US markets, and really markets as a whole, that it can drag averages out of whack pretty quickly, especially when we're dealing with smaller sample sizes. The reality is, the vast majority of crashes are not nearly that bad. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.